on in the economy. I'm just going to give you a handful of statistics. Clay County unemployment rate right now is 3.6%. We call that full employment. Florida's unemployment rate is 4.1 and the U.S. is 4.3. And now here's some amazing numbers. This is year over year. The number of establishments, or basically businesses, has grown from 4,103 to 4,346, a net increase of 143 establishments. Number of jobs, 42,530 a year ago. This year, 46,934, a 10% increase, an increase of 4,400 jobs. And this was the one I double-checked this number. Average weekly wages in all industry sectors inside the county year over year increased from $643 a week, which is an annual salary of a little over $33,000, to $702 a week, which is an annual salary of $36,500, a 9.2% increase in wages inside the county. Pretty remarkable, and that's a testimony to the businesses that operate, testimony to the tight labor market, but that's a number, long term, that's a number we want to get up, and to have a big jump like that so quickly is really a great thing for the county.
My name is Jan Conrad, and I've been in Clay County for over 20 years. 14 of them have been with Regions Bank. You can call me the Bill Belichick of banking. I'm often asked what keeps me here at Regions Bank. Without question, the answer is our commitment to this community and our belief in making life better for our customers and our employees. Regions has called Clay County home for close to 2 decades. In that time, we have been a proud supporter of dozens of organizations. In fact, if you're a nonprofit, I'm sure I've given you one of my Life Green bikes. If not, come see me. Just a bit about Regions Bank as a company. We're a full-service financial institution ranked in the top 15 of banks nationwide and 6 in the state of Florida. Regions is very proud of our customer service awards, and if you look behind me, there's a few of our awards. But the one that I'm most proud of is the most reputable bank in the country the last 2 years by the American Bankers Association. Thank you. Regions believes in advice, guidance, and education to bring you to the next step. I hope today you find our program both educational and informative. I would now like to introduce Sam Garrison. Sam, as many of you, as we all know, Sam is actually a Board of Trustee for St. John's River State College, former Assistant State's Attorney, partner in Kapaloosa, Bradley, and Garrison, and I could just go on about Sam. My pleasure.
Thank you. Thank you, Jan. I am going to touch the microphone. I've asked our panelists to come on up, and while they're making their way up, let me just say, on behalf of St. John's River State College, which I'm proud and pleased to be able to serve as a trustee, along with former Commissioner Wendell Davis here from Clay County, let me thank you and thank the folks at the Thrasher Horn for the great work that you do. I see the folks back there at the table. Thank you all for what you do. This facility is great, and your hospitality is wonderful. We have the Region's A-team, and some guy from Clay County here to talk to us about equities, elections, and economies, which is a fancy way of saying what the heck's going on in Washington, D.C., and how does it affect what we're doing here in Clay County. Let me introduce our panel real quickly. Chris Scribner is to my immediate left. Chris is a Senior VP and Public Policy Manager with Regions. Chris has, in 2010, helped open Regions' Washington office. He operates from there. Prior to joining Regions in 2007, Chris had a career as a business and political reporter in Nashville, Tennessee, here on the First Coast in Jacksonville, and near my alma mater in Birmingham, Alabama. Chris has a degree from Princeton and recovered from that to get a doctorate from an SEC school at Vanderbilt. So please welcome Chris Scribner. Next to Chris is our friend Joe Mobley. Joe's a principal with the Ferentino Group, and a Clay County resident, been involved in everything really there is to be involved with in Clay County and the First Coast for many years. We're glad that Joe is here. Joe is on the board of the EDC and has, like I said, has been involved in really anything there is to be involved with, both on a local and a state level. If you want to know what's going on in Tallahassee, talk to Joe or his colleagues at the Ferentino Group. You'll get a straight answer, and they're the people you need to know if you need to know what's going on in Tallahassee. So please welcome Joe Mobley. To Joe's left is Alan McKnight, also with Regions. He's an executive VP and the Chief Investment Officer with that company. He is Executive VP and Chief Investment Officer for Regions Asset Management. Over 20 years of industry experience in that area. Alan has a bachelor's from Washington and Lee and an MBA from UT Austin. So please welcome Alan. Thank you for being here. And lastly, Richard Moody. Richard is a Senior Vice President and the Chief Economist for Regions. He is the principal spokesperson for the bank on all economic issues. He is formerly a faculty member at JMU in Virginia as part of their Department of Economics. He's a grad of University of Alabama, Roll Tide, and earned his doctorate. There you go. I could count on you, Smallwood. And earned his doctorate in economics from Texas A&M. So please welcome Richard Moody to our panel. I'm going to start with Richard at the end of the table. Richard, without going, where are we now? Where are we now in a 10,000-foot view? There are a lot of uncertainties and high hopes at the start of a new federal administration at the beginning of the year, and what its effect would be on the U.S. economy. So far, it seems we'll be somewhere around steady, but consistent 2% growth. Where are we in the big picture right now?
So the first part of my answer was where we are now is basically where we've been for over 8 years now. So the expansion we're in now started in June 2009. It is the third longest on record. In a few months it will be the second longest on record. Unfortunately, it also has the dubious distinction of being the slowest expansion on record. So we have had average real GDP growth of 2.1% over the course of this expansion. And as Sam alluded to, coming into this year, there were a lot of high hopes and expectations that the economy would shift into a faster year. And basically our view was that expectations were simply too high, right? So the thought was a Republican president, Republican Senate, Republican House would unleash the economy's growth potential through a wave of policy changes and regulatory changes. And our view all along was, well, you don't have to be Chris Scribner to know that the political process is a little bit more complicated and slower than that. So our forecast all along was for basically more of the same. We thought there were significant upside risks from policy, tax reform, regulatory relief particularly. We haven't really seen any of that. So basically where we are is where we've been. The economy is certainly making steady progress. It's just happening at a very slow rate for a lot of reasons. But we did have a little bit of hope going into this year that things would get better, but so far they haven't.
Chris, it seems from afar, there's a lot of talk, a lot of discussion as it relates to potential economic legislation coming through the pipe. It's thus far not a whole lot being done. How would you assess the economic agenda as far as potential legislation or federal action, where we are, and what do you see happening in the years to come?
Very broad question, and let me take a piece of it, and we can return later to other parts. But as Richard said, the expectation that Republicans could quickly pass a series of policy measures that frankly were outlined both in the campaign, in the presidential campaign, but also by congressional leadership, healthcare reform, infrastructure spending, tax reform. So if we look from the legislative side, clearly very little activity. And that also includes trying to pass the budget, which hasn't happened yet, and that has implications for tax reform. So from a legislative side of the agenda, really nothing, has been done. It's a little strong, but very little has been done. Part of the expectation too is the change in behavior by the regulatory agencies. How quickly that can happen or not happen and what impact that will have on business. That can be tied to general levels of confidence, but so there have been some changes to regulation. A lot of that is frankly the absence of new regulation. So just to give a quick number, in the first 6 months of the Obama administration, there were 317 new rules proposed. Significant rules that had to go through the Office of Management and Budget. In the first 6 months of the Trump administration, there have been 67. Now, the idea, the announcement that there would be one, for every new rule, there would be 2 cut, that's sort of aspirational. What does, necessarily what does that mean even when you get into the fine point? But clearly, there is a little less activity from the regulators, and that has had more impact depending on the, on the industry. For instance, in banking, very little because of the nature of the regulations and the most of the regulatory agencies are not executive branch, so not appointed in sync with the presidential term. And in others, say energy, there were some significant rules about to be put into effect that were blocked. So that is more sector by sector. So there have been some changes. If we look at the picture about where the economy's headed. Potentially, in the long run, I'd even add in the Supreme Court, Neil Gorsuch, who has a rule in a very different way than whoever, Obama would have nominated. That nomination had, both have been held last year. So there have been some changes, but there are significant aspects of economic policy, the parts where the federal government can act, where there has not been action. I think we can talk a little bit about what the prospects are.
Sure. Rich, I'm going to come back to you for a second. You were talking earlier that we've had seemingly slow and steady, somewhere around 2% growth, give or take a little bit, really since the Great Recession, coming up, that's close to 9 years now. I mean, is this the new normal? Is this what we've seen previously with the wide fluctuations one way or the other? Is this slow and steady? Is 2% about as good as we can do right now?
Well, I won't say it's the new normal, but it's maybe the new way too familiar at this point. Some of the things are structural constraints, like demographics, for instance. We have relatively slow growth in the labor force right now. A, that's structural, it's not really policy driven, and B, that's a global phenomenon. It's not simply limited to the U.S. So there are some avenues by which we think growth could improve, but that is going to depend on getting the policy mix right. So when I say meaningful tax reform, particularly on the corporate side, particularly any incentives for businesses to engage in capital spending to a greater extent they've done over the life of the recession. Regulatory relief in a meaningful way, infrastructure policy. So there are things that could drive growth. So we're not doomed to 2.1%, but it's going to take a lot of people getting a lot of things right. And then you run into the issue of, well, we're already 8 months into the year through this year. Next year, oh, by the way, is an election year. So is there really a strong possibility that meaningful changes will get done? And I keep using the word meaningful because if all we get either late this year or early next year is a transitory tax cut, it's not really going to do much for the economy's productive capabilities, so it won't get us away from 2%. So it's going to take more fundamental reform in order for us to break through some of these structural constraints that we've been operating under.
Alan, there seems to be a bit of a disconnect. You hear some cautious terms that people describe the economy, yet the market's going crazy. What link is there, or is there not, between those two phenomena?
That's a great question. I think it's really the climbing the wall of worry for Wall Street. And so the markets are assuming that many of the things that Richard spoke to and Chris spoke to are going to occur. When you think about regulatory reform, when you think about tax reform, when you think about infrastructure spending, and not just in a transitory manner, but substantive changes in each of those regards, the market, as Benjamin Graham, who was Warren Buffett's mentor at Columbia Business School, once said, in the short run, it's a voting machine. In the long run, it's a weighing machine. So when you think about the voting mechanism thus far this year, the S&P 500 is up over 9%. The emerging markets index is up over 25%. And international developed markets are over 15%. So risk assets as a whole have done very well. Now, one part of that is interesting to us is that actually small cap has not performed very well. And small cap had a huge rally after the election. It has since sold off, and the reason for that is they would be defined.
Define small cap.
So small cap under 2 billion and under. So small cap all the way down, and they're actually now negative for the year. So the Russell 2000. And so the challenge there is that folks had really high hopes coming into this that the animal spirits and serious changes were on plate. And since it hasn't occurred, they are also the ones who get hurt out of the box, versus the larger companies who have broader multinational exposure and able to benefit from things that are going on in Europe, which have improved dramatically, and things that are going on in Asia and the emerging markets, which are also included in line with that.
That what you just described, translated, if you can, how that affects folks in an environment like we're in. A lot of small businesses, that's the kind of heartbeat of our economy. What does that mean or not mean for folks in our context?
Well, one, from listening to the data earlier, the fact that you're running at 3.6% unemployment, I think you're the envy of most of the country, quite honestly. So that's a great starting point when you look about what's going on. You said, I think wage growth of 9.2%. I mean, it's very favorable here, obviously. Florida as a whole has obviously benefited quite a bit over the last few years when you look at the core tenets of business growth. When you think about it from a small business perspective, what does this mean? The sooner there can be some policy reform, the better off they will be, because in a small business environment, you're thinking more about your balance sheet every day, your P&L every day. How are you going to get that next project? How are you going to actually spend money? And that's really what we need and what the market needs to take the next leg. So we're in the second longest bull market in history. The number one being 1990 to 1999. So for us to get that next leg, companies, CFOs, CEOs, business owners have to believe that there is a reason to go out and spend more. Capital expenditure, adding new workers, and taking it even here in town, in the county, from 3.6 even lower. Or having to pay their employees even more to say, look, we're really going at all cylinders here. We need to see, we've got to add more to be able to grow capacity and to be able to deliver.
Richard, if we could predict when a downturn would come, we'd all be sitting on an island somewhere. Not that EDC luncheon, but putting your prognosticator hat on, where do you see us coming in terms of how long this general trend towards small but consistent growth is going? Are we at risk of seeing a downturn?
Well, actually, I get that question a lot. You tell people the expansion is starting in its 9th year, and it's the second longest on record, and they automatically assume, well, that means the end must be near. And what I tell people, and you may have heard other people say it, but I was the first person in recorded history to say it, is that expansions don't die of old age, right? So it's not that you hit 9 years or 10 years and then you have a recession. So we can continue to muddle on for, some while yet, because there's still a lot of, believe it or not, this long into an expansion, there's still a lot of unused capacity in the economy. So for instance, if you look at the manufacturing sector, right now only 75% of U.S. manufacturing capacity is being utilized. So we have considerable excess capacity in the industrial sector. And despite the fact that the unemployment rate nationally is 4.3%, there's still a lot of slack remaining in the labor market, as evidenced by the fact that wage growth remains fairly sluggish even this long. We're on a record long streak of job creation in this country. So normally what you see during expansions is you tend to have imbalances form in the economy, whether the real economy or in asset markets. And then the central bank steps in and starts raising interest rates, and that kind of tips the economy into recession. So we're not really close to that point. And if there are imbalances right now, I think the Fed would be more worried about asset prices than the real economy. So as long as the Fed moves gradually, the economy continues to absorb the slack. And Alan alluded to this. One thing we're seeing right now that we haven't seen in over a decade is all the major industrialized countries around the globe are now growing at the same time. So we've not had synchronized global growth in over a decade, and that's a significant lift to U.S. exporters, and particularly markets like this that have big infrastructure and port facilities that are parts of their economy. So we can keep going as long as the policymakers don't get in the way.
Joe, throw a bit of a curveball here. So certainly what happens in Washington, D.C. has a direct impact on what's happening here in Clay County. My 2 cents, I think what happens in Tallahassee is just as, if not more important to what we're dealing with here on the ground. You've heard your colleagues here describe that Florida is ahead of the curve in terms of unemployment and growth. What do you attribute that to from a policy standpoint in terms of what's happening or not happening in Tallahassee? And where are we looking? Where are things going in the years ahead as we try to continue to keep that going?
First, let me address the elephant in the room. Why is this guy up here with these guys? So, I got a call. They said Tom Brady, Matt Ryan, and Aaron Rodgers are on a panel. Mr. Bortles, can you come and join us?
I think he may be available today. He has some time, yeah.
Thanks, Sam. I appreciate it. You're right. Florida, from the political side, it's somewhat remarkable that even as we're a purple state nationally, Republicans have been in control for nearly 2 decades, almost complete control. And so that, from afar, you'd say, well, that's why they get it right. They're all on the same page. But if you look a little closer, Tallahassee, there's very few rubber stamps. You have philosophical disagreements within the Republican Party. For a recent example is Governor Scott is really big on economic incentives to attract new business to the state, and also spending heavily on tourism marketing. And obviously those are our 2 biggest financial sectors, tourism and we count on growth here for revenue. And then House Speaker Richard Corcoran is very much against that. He believes that tourists come to Florida because they think it's a great place, and that the bottom line is going to drive business growth to Florida. So that kind of carried this past legislative session, was the disagreement between those 2, and they did come together in the end. And if you ask me, I think they're both right a little bit. I think we have the ability to spend state dollars for game changers, for big companies to come here, and we've done that well. And then sometimes the market takes care of that. One thing I think that really helps us, and I just read an article about Connecticut this morning, is the lack of personal income tax, state income tax. And I think that drives executive decision-making to come to Florida. And so that's really it. I don't think we're going to see that change. I think any politician that goes after the state income tax will be a former politician. So, that's kind of my view on that.
I think that will play forward somewhere. Chris, let me transition back to the federal level here real quick. It was referenced earlier that you see a lot just in the political press or the news. You're hearing the word comprehensive tax reform come up a lot, and there was some discussion about it earlier. But yet we don't see breaking through what that looks like with specific policy proposals, let alone what could potentially get through both chambers and then onto the president's desk. Put your crystal ball in front of you here and tell me, where do you see potential corporate tax reform looking like, and then does it have a chance of actually happening?
It's one reason why Richard and I are on opposite sides of the panel, right? He talked about meaningful tax reform. What could that be? So I think what is clear on the federal level is top-line messages are easy to be unified around for Republicans, but details are difficult. They're unable to do it because there are real divisions within the Republican Party. Comprehensive tax reform. Actually, you can get Republicans and Democrats to agree to comprehensive corporate tax reform, simplify the code. Then you get into the details, and then putting together a majority that can pass the House, which you only need Republican votes, and a majority in the Senate, where, depending on the rules, you only need Republican votes, but that's still difficult to get 250. Because then you got the vice president breaking a tie, is also difficult. Complicated by a little bit by the fact that, you know, one never would imagine that you'd have to check your Twitter feed to see if the president has insulted the Senate Majority Leader in his own party, which complicates the politics of getting your stuff. So, you know, at the end of the day, to kind of jump to, you know, the end of the message first and come back and fill in a few details. You know, our prediction, you know, as regions and our government affairs office and what we tell our senior management and what we've been saying for a while is really what we expect at the end of the year isn't comprehensive tax reform, but are some tax cuts, some cuts to the That's what we expect. Now, the message or the talk in Washington is still comprehensive tax reform. There's still some optimism. There are barriers in the way. But what will it look like? Well, the rate cuts at 15% or 20%, those are not going to happen. The discussion in corporate rates is somewhere between 22 and 25%. To reach that and keep it revenue neutral, you would have to essentially get rid of every deduction on the corporate side. That is extraordinarily difficult, right? There are thousands of them. There are people that lobby heavily in specific industries to keep them. So to make any changes to the rate that are significant, down to 25%, probably even revenue neutral, that could go away, you have to take out a lot of corporate, you know, tax breaks. Frankly, you also have to introduce, and there's discussion on the personal side, taking away mortgage interest deduction above $500,000, you double the standard deduction, taking away state and local tax deductions. Those are big in some states, less in other states. So you complicate the debate and make it even more difficult. Just to tie it to, so there are a lot of complications. To tie it to kind of business, what does this mean? And you know, what does the federal government, how do their actions or inactions influence business? As I was talking to some conversations with executives in Birmingham with regions and throughout our footprint, the idea of a small business, one of the deductions that would go away would be the interest deduction. A big part of how you manage how you manage your bottom line and borrow money. So is that going to go away? Do I borrow now if my expectation is the tax rate's going to go down to 22%? Does that affect short-term decision making? It might not affect long-term decision making over a window, but it might affect decision making over the next 6 months as businesses wait to know what the answer is. The other piece to offset the lack of interest deductibility is immediate full expense for small businesses, probably. Not all businesses. Still would need to be defined. So there are a lot of variables to be worked out, and some of these things actually do have inaction can have an impact, or debate, and expectations can have an impact on how people make judgments.
I would like to bring it a little more local to Clay County, and we discussed this in our pre-meeting today. We've got an issue with housing commensurate with the workforce in Clay County. We've got companies coming here, but the wages are not always justifying the commute for the wage earners. So that's something that it can be and has been kind of a hot potato politically. It's something we're going to have to address here in Clay County.
Yeah, my key theme would be we expect more volatility. We think that it's going to be harder, to Chris's points, to see complete follow-through on a lot of what's expected in the market right now, what's baked into the market right now. And in addition to that, earnings are going to be harder to come by. The comparisons from the prior year were really easy. So we had some really good numbers at the first half of the year. As we get into the second half of the year and the first half of next year, it's just going to be harder to continue the path that we have in markets right now. So we anticipate greater volatility. It doesn't mean there won't be opportunity, but just to be mindful of that, not to get caught up in the circumstances.
And I would just add that if you're looking nationally, the last 8.5 years or so haven't been all that spectacular, but Florida has been easily outperforming the U.S. as a whole. So you've managed to do that despite what's coming out of Washington, what's not happening in Washington. So the advantages of Florida are many, and this would include the Jacksonville metro area, healthy demographics, a favorable business climate. One of the huge advantages in the local economy is just the transportation infrastructure. So things can continue to proceed here at quite a healthy clip, regardless of whether we get tax reform or not. But the two caveats I would throw out there are a couple of ways that the policy could still get in the way, and anything that would have an adverse effect on global trade and any significant curtailments in immigration would be felt in Florida more so than a lot of other places.
Well, I want to honor our time. It's a little bit after 1 o'clock, so we please thank our panel.